In this video, we'll express the relationship between the risk and return of a portfolio that combines risky assets and risk-free assets on a graph. So we'll use the horizontal axis as the standard deviation or the risks, and we'll use the vertical axis as the return here. So let's start with the risk-free asset. So since it's risk-free, the sigma of any risk-free asset will be 0. It has no risk here. Okay, so we'll assume that the risk-free rate is somewhere here. Right. So next we will have risky assets. So think of it as a package of different risky assets here. So here we have sigma k. If we're just buying the risky assets itself without any risk-free assets, then we would encounter, or we would bear the risk of sigma k here, and the return for that risky asset will be rk here, right? So now we can combine these two. So we can only change the weight for the different asset classes, and then we would have the portfolio return anywhere between these 2 points, right? So since it's a linear relationship, which we have already proven, and the gradient is basically the Sharpe ratio here, so we can connect these 2 dots, and anything or any point on the straight line are the possible combinations that gives us different returns and different risks here. So to achieve different returns, or to control our risks within some tolerable range or acceptable range, we need only to adjust the weight for the risk-free assets or the risky assets. Okay, both would work because we only had 2 different types of the assets, so they always add up to 1, right? So we can further extend this if we allow short selling. Yeah, so we can borrow at the risk-free rate and buy even more of the risky assets to achieve a higher rate of return for the portfolio while bearing higher risks than the original risky assets risks, right? So this is called the capital allocation line here. So it basically tells us how much are we putting into the risk-free assets or the risky assets here. Okay, so if we're at this point here, we're basically getting 100% risk-free assets here. So we're only getting the intercept, which has 0 risk, and we're getting the risk-free rate. So at this point here, we're getting 100% risky assets. So we're putting all of our available funds or money into the risky assets of our choice. Okay, and anything between these 2 points, we're basically saving a little bit. So we're combining some of those risky assets with some of those risk-free assets. We're buying both of them. So here we're basically savers, right? Right. So if we are going to increase the portfolio risk and consequently its return, then we're going to borrow at the risk-free rate. Okay. So here we have the borrowers. So whether to borrow or to save depends on the individual's risk preferences or utility curves, which we have seen before, right? So here we have a very big or essential assumption, is that we can borrow and save at the same rate, which is the risk-free rate. So the critical assumption here is that we can borrow and save at the same rate. Okay, so this is how we allocate different types of our assets, namely our risk-free assets and risky assets. So we haven't really talked about what kind of risky assets are we going to choose. Okay, so for now you can think of any package or any portfolio of risky assets. So if we choose a different risky asset, so maybe it's going to be here, somewhere here, let's call it sigma k prime, and it has a lower return. It's called RK prime. Okay, so now we would have another capital allocation line that cuts through these 2 points. right? Or we can have yet another package or portfolio for your risky assets. So it's going to be here, for example, and let's call it sigma k double primed, and consequently rk double primed. So we would allocate our resources or our asset classes here, right, in this way. Okay, and still, if we go past this bit, okay, if we go past this bit, we'll be borrowing at the risk-free rate, same as here. And if we choose any portfolio that lies between the 100% risk-free and 100% risky, then we'll be saving somewhat our funds at the risk-free rate. Okay, so there will be savers and there will be borrowers. But this is not the final conclusion yet, right? Because we haven't really talked about what are the available risky assets in the market. And we'll explain that in the next video. And I'll see you there.